Good morning and welcome to the ParkBridge Wealth Management Winter Webinar Series. This program is entitled Use It or Lose It, Securing the Use of the 13 million plus federal estate, gift, and GST tax exemptions before sunset. For those who don't know me, my name is Jonathan Shenkman. I'm the President and Chief Investment Officer of ParkBridge Wealth Management. In that role, I serve in a fiduciary capacity to help my clients achieve their financial objectives. The goal of my program is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 20 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning, and you can read my work in a variety of periodicals, including Barron's, CNBC, Forbes, Kiplinger, The Wall Street Journal, The CPA Journal, and Trust and Estates Magazine, to name just a few. You can see all my work on my website at parkbridgewealth.com/articles or by following me on social media at Jonathan on Money. Additionally, you can check out my weekly podcast, which is also called Jonathan on Money, and you can listen to that on Apple, Spotify, or wherever you get your podcasts. Today, we're privileged to hear from Jay Scharf and John Kiely, both attorneys at McDermott, Will, and Emery. Jay Scharf is based in the firm's Miami office and advises high net worth and ultra high net worth individuals, families, and family offices. He delivers customized strategies to help his clients attain their personal and estate planning goals and minimize income and transfer taxes. Jay guides clients through the design and implementation of sophisticated estate plans with a focus on preserving a family wealth in a manner that meets each client's unique goals. A significant part of Jay's practice involves trust and estate administration. He advises clients in all aspects of Internal Revenue Service and state tax compliance with respect to trusts and estates, including the preparation of federal and state estate tax returns and defense of fiduciaries in estate and gift tax audits. John Kiely is based in the firm's New York office, where he focuses his practice on advising high net worth individuals and families on a full range of estate planning and gift planning issues, including the preparation of wills, revocable trusts, spousal lifetime access trust, grantor retained annuity trust, life insurance trust, and qualified personal resident trusts. John frequently lectures on diverse estate planning topics such as gift planning for qualified small business stock under Section 1202, the income tax aspect of estate planning, international estate planning, options for illiquid estates and significant estate tax liabilities, and proposed legislative and regulatory actions that could affect wealthy individuals and families. Today, Jay and John will speak on Use It or Lose It, securing the use of the $13 million plus federal estate, gift, and GST tax exemptions before sunset. And with that introduction, I'll now turn the program over to John and Jay.
Thank you, Jonathan, for that introduction, and thank you, everyone, for joining us on bright and early in the morning after this holiday weekend. Nice snowy day here in New York. Good time to go through Use It or Lose It. So before we get into the portion of our program that will go over how exactly we use it or lose it, it's important to have a background understanding of the tax law. The Tax Cuts and Jobs Act of 2017 temporarily doubled the estate and gift tax exclusions and generation skipping transfer GST tax exemption amount and indexed them for inflation. Now, to give you some context, before we get into the current numbers, under the current rules, we have an exemption of $13,610,000, and that is the exclusion for both estate tax, gift tax, and GST tax exemption amount. The gift tax annual exclusion amount is now $18,000. And to the extent that a person goes over those exemption amounts, the tax is imposed at a flat rate of 40%. Now, to give you some context for those numbers and why we feel they are so significant and so historically generous, back in 2004, the federal estate tax exclusion amount was a mere $1.5 million, and the gift tax exclusion was $1 million, and the annual exclusion amount was $11,000. That increase of $11,000 to $18,000 is solely the result of inflation adjustments over that period. Fast forward to 2017, The exemption has increased to 5.49. 2018, the next big seminal event, those exemptions double to 11,180,000 before we get to the current level of approximately 13.6 million that we have as of January 1, 2024. Now, major caveat to that 13.6 million exemption. That exemption will sunset on December 31st, 2025, at which time it will be cut in half as of January 1, 2026. So the way this works is it goes back to the 5.49. Then there are the series of inflation adjustments that would have applied over the intervening years, bringing that to at least 6,805,000 plus another inflation adjustment to bring it up to whatever it will happen to be on January 1, 2026. Now you might wonder, why on earth would there be this crazy increase in the exemption to just be followed a few years later by it being cut in half? This is classic congressional accounting magic. When they are scoring the revenue cost of legislation such as this, they assume that all of these sunsets do in fact come into place, which allows the legislation to look cheaper, at least on paper. And the problem is kicked down the road and potentially gets resolved unless there is the quite foreseeable possibility of inaction in DC. So how exactly do we go about calculating this tax? Well, it's a funny tax. The federal estate and gift tax exclusion amounts can be thought of as an integrated running tally. Now, we went over at the beginning, the exemption is now 13.6 million. Suppose John Doe makes a gift of 5 million in 2022 and dies in 2024 with $12 million in assets remaining. So is his estate free and clear? Because the 12 million is certainly under the 13,610,000. The answer is no, because the gift amounts are added back and the tax is computed on 17 million, and the tax will be 40% of the 3,390,000 that exceeds the exemption amount, or 1.356. As shorthand, you can think of lifetime gifts as using up a portion of a person's federal estate exclusion. You can think of the $5 million gift as having used 5 million of the 13,610,000 exemption, leaving 8,610,000 in exemption, and there being a 40% tax on the difference between 12 million and 8,610,000, getting you to that same 1,356,000. So with this paradigm, why make a gift? Well, one reason is that post-gift appreciation escapes future transfer tax. For example, if gifted property is worth $20 million in 2024, the 15 million in appreciation that would have been in the taxable estate has escaped transfer tax. And that would be, in that example, about $6 million in transfer tax savings. There's another critically important reason, and it relates to this scheduled sunset of the exemption. There had been a concern that if the exemption was cut in half, that there would be a clawback if a person had fully utilized their exemption and then died when the exemption amount was lower. Fortunately, the IRS has clarified that such a clawback will not take place. So it provides the opportunity to utilize the exemption without that lingering concern that there could be a problem in an estate tax administration. Also, don't forget that states want their piece of the pie as well. There's a state-level estate tax in certain states. In New York, there's a 6,940,000 estate tax exclusion and a progressive rate structure that technically starts at 3% and is 16% on amounts in excess of 10 million $100,000. However, that is not as generous as it sounds. There's a rapid phase out of the benefit of the exemption for estates that are slightly in excess of the exemption, and an estate that is more than 5% over the exemption amount will receive absolutely no benefit from the New York exemption amount. For example, an estate worth $6,930,000, just $10,000 under the limit, owes no estate tax. But an estate worth $7,300,000 will owe $678,000 in estate tax, an effective tax rate of over 100%. This is referred to as the New York estate tax cliff. New York does not have a gift tax, so a lifetime gift can make a lot of sense. If someone is hovering on that margin, they're in the they're 7.5 to 8, a little over that. If they're trying to bring themselves under that cliff amount. Watch out though, because gifts in excess of the annual exclusion amount within 3 years of death are brought back into the New York taxable estate. Connecticut has both a gift tax and an estate tax, and currently matches the federal exclusion amount of $13,610,000. Now, New Jersey has eliminated their estate tax. However, there is an inheritance tax that can apply. Fortunately, spouses, descendants, parents, grandparents, and stepchildren are exempt. So who is not exempt? Well, siblings, in-laws, nieces and nephews, cousins, and just garden variety friends are subject to the inheritance tax. Florida, looking attractive on a nice snowy day like this, also does not have an estate tax or an inheritance tax. Now that we have this primer on the background of the tax law, I'm going to turn it over to Jay to talk about some of the really neat planning strategies that can be utilized to take advantage of these exemption amounts and preserve these important tax exemptions.
Thank you, John, for that great overview, and thank you everyone for joining us this morning. Just to put a little bit in perspective, the taxes that John mentioned for a New York resident between the federal estate tax and the New York estate tax could be an effective 53% tax rate. Meaning if somebody has a $100 million estate, $53 million of that will be going to the government without adequate planning. So taking that into consideration, I'll go through briefly some of the popular techniques to secure the use of one's $13.6 million exemption. And then there's more sophisticated planning that could help reduce taxes on assets that exceed the exemption. As I'm going through these techniques, please keep in mind that generally these strategies can be implemented using not only cash and marketable securities, but also real estate interests, many other types of investments, and family businesses. So the first technique is the use of spousal lifetime access trusts to secure the use of the exemption. Or if somebody used a portion of his or her exemption, the slats can be used to secure the use of the remaining exemption. As John mentioned, gifting also removes those assets entirely from the New York estate tax base as long as the donor lives for 3 years after making the gift. The way the slats work is that the grantor creates an irrevocable trust, but the grantor spouse is a beneficiary of the trust. Typically, the trustees would have full discretion to distribute income and principal, and the spouse can be either the sole beneficiary during the spouse's lifetime, or typically the grantor's descendants are also discretionary beneficiaries of the trust. The benefit of the slat is that it provides the grantor the opportunity to secure the use of the grantor's exemption while still providing some degree of access and control to the grantor by one of two ways. First, since the spouse is a beneficiary of the trust, distributions of trust property can be made to the spouse and make its way to the grantor if necessary. Secondly, the grantor can have the unilateral right to borrow from the trust. As my mentor says, the slats are the darling of estate planning. So this is a technique where you really get to have your cake and eat it too. However, there's still a small chance that this is at risk of being eliminated sometime soon. As we know, it's on the minds of Congress, which I might touch on later in the presentation. So It's a good idea to complete transfers to slats as soon as possible if slats are the appropriate vehicle. Also, spouses can create slats for each other as long as they are non-reciprocal, which is critically important. So both spouses' exemptions can be used and both spouses can have access to the trust. So these slats are really great vehicles to secure the use of the exemption and still have access to the trust assets. Another powerful technique to build on the slat, or it could be a standalone trust, is the dynasty trust. The dynasty trust is intended to last for multiple generations, and the assets will continue in trust by allocating GST exemption to the trust on a timely filed gift tax return. This would allow the trust assets to be protected from estate, gift, and GST taxes for multiple generations. So if you run the numbers on a dynasty trust with eliminating estate tax at multiple levels, you gain at least a generation or two of additional wealth just by preserving the taxes. So the dynasty trust can also provide great creditor protection and could also be a technique to avoid premarital agreements for your children and grandchildren. The next technique involves life insurance trusts. A life insurance trust is generally an irrevocable trust that allows the trustees to own and maintain one or more life insurance policies on the grantor and allows the trustees to pay premium using the trust assets. We also have a bit more creativity when using ILITs, in that if appropriate, we have them funded with fund interests or other income producing assets that generate cash flow to pay for the premiums within the trust. Generally, the primary benefit of the life insurance trusts is that people tend to think that life insurance is tax-free. It's not really tax-free. It's generally income tax-free, but it's still subject to estate tax. So the life insurance trust allows the life insurance policy and the proceeds to be excluded from the grantor's taxable estate. The life insurance trust beneficiaries can also be a spouse, so it can be a slat, as long as the policy is a single life policy. If the policy is a second to die policy and the spouse is one of the insureds, then it cannot be a slat. So it's very important to remember, and we see this sometimes not complied with. So it's really important to remember that if you're dealing with a second to die policy, that the spouse is not a trustee or beneficiary of the trust, as that would create an estate tax inclusion issue. Also, very importantly, in order for the life insurance trust to work and keep the policy out of the grantor's estate, the trust needs to have the policy issued to the trust initially. Or if the policy already exists, there are ways of getting the policy into the trust with little to no gift tax or use of exemption. The third technique is the use of a grantor retained annuity trust, or GRAT. The GRAT is a trust to which a grantor transfers an asset that's intended to appreciate, and the grantor receives an annuity over a minimum of 2 years that's equal to the fair market value of the asset being transferred to the GRAT on the date of the transfer. So the GRAT allows you to basically freeze the value of the asset, and all the appreciation passes to the remainder beneficiaries of the GRAT after the annuity term without using any of the grantor's estate and gift tax exemption, because the grantor is taking back an annuity equal to the fair market value of the assets transferred to the trust. There is a risk, however, if the grantor dies during the annuity term, then the GRAT assets are includable in the grantor's estate. Some of the great benefits of the GRAT is that it's a statutory trust, so that if there's a gift tax audit that adjusts the value of the asset being transferred to the GRAT, then under the Treasury regulations, the annuity being paid back to the grantor is self-adjusted, so there would be no additional gift tax in the event of an audit. But it is critical that the initial valuation of the assets is a qualified appraisal for federal gift tax purposes. Recently, the IRS took the position that an entire GRAT would be disqualified, resulting in a huge tax liability because of a defect in the appraisal. Also, when funding these trusts with real estate interests, you need to be mindful and analyze any real estate transfer tax costs, because the annuity can be treated as consideration for purposes of the real estate transfer tax. The next technique is the ability for the grantor of a grantor trust to engage in leveraged sales with selling assets to the grantor trust. Generally speaking, this means selling an asset to a grantor trust in exchange for a promissory note. And this does not use a grantor's exemption because it's being sold for its fair market value and it's not being gifted. So this works if either the grantor has exhausted his or her exemption, or for other technical reasons, the grantor cannot gift the interest in question. And since the grantor and the grantor trust are the same income tax owners for income tax purposes, there is no gain recognition on the sale. From an estate tax standpoint, all the future appreciation of the asset being sold to the trust grows outside of the grantor's taxable estate and within the grantor trust, which is hopefully a dynasty trust. So it maximizes the benefits of the grantor's exemptions and transfers the future appreciation outside of the grantor's estate for multiple generations. Here too, when dealing with real estate interests, you need to be mindful and analyze any real estate transfer tax costs, because the sale and the note, even though it's being made to a grantor trust, can be treated as consideration for purposes of the real estate transfer tax. So these are very big picture, very effective techniques that should be carefully considered, and if appropriate, be implemented as soon as possible. If time permits, I will run through some of the recent Green Book proposals made by the Biden administration that puts some of these strategies at risk. Now I'll turn it back to John to discuss gift tax reporting.
Thank you, Jay. So let's say a client or you have implemented one of these fantastic planning strategies. Next step is filing a gift tax return, because the taxpayer is obligated to file a gift tax return if they used any portion of their exemption amount. The gift tax return, Form 709, is due on April 15th after the year of the gift, and that deadline can be extended by 6 months. Fortunately, filing for an extension of time to file a personal income tax return automatically puts the gift tax return on extension. The gift tax return is also used to claim the allocation of a taxpayer's generation skipping transfer tax exemption amount. Cautionary note: do not rely on the return itself for a proper GST tax exemption allocation. A rider will need to be attached that makes a formula allocation to take into account that values may change upon audit. A taxpayer and their spouse must file gift tax returns if they wish to split gifts in order to take advantage of both of their exemptions. This is true even if it's merely annual exclusion gifts. Gift splitting is a tax fiction that treats a gift from one spouse as being made from both of them so that they can each use their annual exclusion amounts plus their full exemption amounts. So what does a gift tax return include? Well, cash is, of course, the simplest item to report. Okay, a little more complicated: transfer stock in a closely held corporation. We're all used to seeing brokerage statements that say what the stock was at the end of the day. Is that the value? If it's closed at $25 today, you might be surprised that no, it's not. The gift tax value will be the average of today's high and low trading prices. This is a common thing that's often done incorrectly on gift tax returns. A gift of real estate will require an appraisal from a qualified real estate appraiser, which must be attached to the return. The interest in a closely held entity will require a business level appraisal, which will consider whether valuation discounts could apply. That business appraisal starts by determining the full value of the business and then determines if a percentage of the ownership is worth less than a pro rata share of the full value of the business, taking into account discounts for lack of marketability and lack of control. Lack of marketability takes into account that there's no publicly traded market for a minority interest in a closely held enterprise, even one that is very successful. Also, with lack of control, you are subject to the whims of the controlling shareholders, absent egregious misconduct. And even then, you have to prove it. And so there are real economic reasons why a minority interest that doesn't have control is in fact worth less than a pro rata share of the company. Now, suppose a client is told the appraisal is going to cost X dollars. They say, that's outrageous. I already know what the company is worth. They go ahead and insist on filing a gift tax return without any supporting appraisals for the real estate or for the gift of the minority interest in a closely held business. The taxpayer marks their calendar and feels pretty good when 3 years have passed and says, all right, I'm out of the audit period. Is that taxpayer, in fact, free and clear if they made it to that point? Well, watch out for the adequate disclosure rules. If the gift is not adequately disclosed, then the statute of limitations on assessment never begins to run. The failure to adequately disclose a gift may be raised on an audit of an estate tax return. At that point, the taxpayer, who may have been the best witness to support a legitimately low value, is dead, and the relevant records may be missing. It is very difficult to get financial records that go back more than 6 years from a financial institution. The taxpayer's heirs may then end up paying an unnecessary amount of transfer tax, in addition to substantial professional fees negotiating the resolution of the audit. Also, another cautionary note: appraisals take time, and business appraisals typically take months to be finalized. Taxpayers should not wait until November 1st, 2025 to start thinking about appraising assets and making gifts. It takes a number of months to gather the information the appraisers will need and to get those appropriate appraisals. You do not want to be in the situation of having to guess about whether you have gone over the exemption amount. While there are formula methods to try and avoid accidentally giving an amount that's over the exemption amount, those methods carry their own risks, and it's really better not to go there. Now I'll turn it back to Jay again for some quick thoughts on some of the other legislation that could potentially be coming down the pike.
Thanks, John. Just to piggyback on John a bit, these transactions that I mentioned are relatively painless type of strategies, and they're very effective, but they're really only as good as you report them on the gift tax return properly, and they hold up in an audit. So what John presented really helps close the loop on the strength of these strategies. We have 3 minutes left, so I'm going to run through briefly showing you how these strategies that I mentioned, the SLATs, the Dynasty Trust, Irrevocable Life Insurance Trust, the GRAS, and sales to intentionally defective grantor trusts are at risk by being eliminated by Congress, so the time to act is now if they are appropriate vehicles for you or your clients. So the first item in the Green Book, and there are more, this is just a couple ones that leap out at me, but gifts or inheritances now of appreciated property is proposed that they would be realization events for tax purposes. So somebody wants to gift 100 shares of Microsoft that's now trading at $200 and they originally bought it for $150. That gift will be a trigger event, realization event, and result in $50 of gain. Takes a lot of the benefit out of gifting. Secondly, there would be gain recognition on unrealized appreciation of assets just sitting in a trust or partnership or another non-corporate entity. If they're just sitting there for years and haven't been subject to a recognition event within 90 years, then the government would automatically apply a deemed realization sale and would charge capital gains on those assets, even though they're not being sold. And good luck coming up with liquidity to pay those taxes when the asset isn't sold, but is considered to be sold. Another big one in the real estate industry is to eliminate 1031 like-kind exchanges for real estate for gains in excess of $500,000 or for a joint return of $1 million. A 10-year minimum term for grats. Right now, there's a 2-year minimum term for grats, which makes it fairly easy. And there's no minimum percentage for a remainder. Under the Green Book proposals, there'll be a 25% minimum remainder, meaning a 25% minimum gift or exclusion amount. We have 1 minute left. So the last item is gain recognition on leveraged sales with grantor trusts. The last strategy I mentioned was selling assets to a grantor trust for a note. And I said there would not be any income tax because it's a grantor trust to grantor sale. Well, under the Green Book proposals, this would be a realization event and subject to income and capital gains taxes as appropriate. Just want to thank everybody for joining us today. And Jonathan will mention our contact information to please reach out anytime with any questions or comments. Thanks again.
Great. Thank you so much. Thank you, John and Jay. If anyone has any specific questions, new business opportunities, or any other issues they'd like to discuss, please feel free to reach out to John, Jay, or myself where appropriate, and I'll be sure to include their contact information in the follow-up email tomorrow morning to this program. As I mentioned at the onset, the goal of these programs stay up to date on timely wealth management related topics and to collaborate where appropriate. And I think we can all agree that the clients who are best prepared are the ones that are served by a team of knowledgeable advisors. 3 more quick items before I let you go. First, my winter webinar series continues on February 1st on Spousal Lifetime Access Trust for mass affluent $1 to $10 million taxpayers, featuring Martin M. Shenkman of Shenkman Law. I'll send out an invitation to this program in the coming days. In the meantime, if you have a friend, colleague, or client who would like to be notified of my upcoming webinars, they can email me with the word webinar in the subject line. I'll add them to my webinar distribution list. My email is jonathan@parkbridgewealth.com. Second, you can follow all my work on Twitter and Instagram at Jonathan on Money. You can also listen to my weekly podcast, also called Jonathan on Money, which is available on Apple, Spotify, or wherever you get your podcasts. And you can watch my new daily financial planning clips by following me on YouTube at Jonathan on Money as well. Third, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees. I thank you in advance for that. And with that, this concludes today's session. Please stay safe and healthy and have a wonderful day, everybody.